People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth online. As always, it's zinniawealth.com. That's ZINNIA wealth.com. And you can see on the website there's a gold box. It says complimentary retirement consultation. What does that mean? That means it's a free meeting to sit down, get your questions answered, and talk about your concerns about retirement. Let's get that conversation going, get a date on a calendar, and start to do the math on your retirement. Give Charisse a call. 833-368-3680. All right, we're going to dive in just a little bit here on how Charisse puts together portfolios. And, you walk in and say, okay, Charisse, how would you invest this money? I found an article in Investopedia, and it talked to a financial advisor, and they said what you should do with this is start with the job, not with the product. In other words, asking you, what do we need? Do we need income? Do we need long-term growth? Do we need short-term growth? Do we need tax-favored savings? All these different things. You hear people say, look at the end and work backwards. Is that something that you do? Is that a philosophy that you kind of follow, something that you put in there?
Well, if you're 200 pounds and you want to get to 160, there's a mixed bag of strategy there. Right?
Okay, well, yeah, but you have the end in mind. I want 160. Yes. Okay, so now we know what the end of the journey is. How do we get there? Okay, I got it.
Right. And the problem is most people, you walk into them. Let's say you walk into a big bank or brokerage firm. You bring your statements. You're looking for a second opinion. You just left your 401k. You retired. You walk into this big bank or brokerage firm because they're big and they're probably a good company, right? And you walk out with a portfolio that's full of stocks and bonds, maybe a CD, and that's it. They're selling you a product. They're selling you some mutual funds. And so instead of that strategy, I call that the old school strategy. That is your grandpa's strategy. Listen, we don't do that here. What we do is we build out that you want to be 160 pounds in 10 years and you're 200 pounds now. We're going to build out a strategy. And the only person who could screw it up is you, right? Or the person who's actually managing your strategy, if they're a bad personal trainer, right, or they're just not doing their job, right? Most personal trainers are always doing their job. But the same thing with the advisor. So if you say, hey, I have $1 million here, Charisse, and I'm getting $50,000 in Social Security, but I need another $50,000 to spend for the next 10 years, I still want my $1 million to grow while I'm taking $50,000 out. Well, I have a big job because if you have $1 million and you're taking $50,000 out, that's 5%. And you're supposed to follow the 4% rule, not take more than 4% so you don't run out of money. But you're lucky you sit with me and not a typical stock jock because we will implement the plan. We will get you that $50,000. Your portfolios will grow because we're not just doing a 60-40 mutual fund portfolio or a 60-40 just stock portfolio. We are building things that create an inflation adjustable income. So you're going to get more money every year if you need it, but it's built into the plan. And then we're going to have probably 6 to 7 different buckets doing different things. And one of those buckets is a 60-40 portfolio. So yes, you're still going to get that 60 portfolio the stock jock's going to get you. But we're also going to build in other things that we know that you're going to need as we're helping you build your retirement by design. It has to be designed. It is not cookie cutter. I am so tired of the cookie cutter world, Randy, because we work so hard here to design your portfolio. And 3 people can come in one day and all 3 people have a totally different plan on when we turn it on and if we need to build income or if we need more growth or more of a tax strategy, a dividend strategy, right? So it's important to us that when you are retiring, you're retiring by design, not by hope, not by just a basic strategy, because it doesn't work as well. And I can show that to you.
Well, one of the things about retirement planning, I got to believe, is people come in, as you say, and they all have different needs and they all have a different idea of what they need from someone like Charisse. Somebody might walk in, you might walk in and say, all I need is my money to move forward. I need growth. And it's all about investments. But somebody else might come in and say, you know, Charisse, I'm worried about long-term care. I'm worried about health care. I'm worried about taxes in retirement. I'm worried about legacy. I don't have that part nailed down. That's looking at the end in mind, going way down there and saying, okay, let's solve those problems as well, and then get that investment plan for you as well so you have the income that you need. You're going to go about it differently than anybody else. When she says no cookie cutter, that's what it means. That means your plan is going to be different from anybody else's. Let's sit down and build your plan. Do your retirement math. Here's the number, 833-368-3680, 833-368-3680, or online, ZinniaWealth.com, ZINNIA Wealth.com. What does that do? Let's get a date on a calendar and start the conversation. Talk about your concerns and what you want from your retirement plan, what you need, what you're thinking about. What you've done? What do you want to do? Let's put it all together. 833-368-3680. Well, I looked at this headline, Charisse. It says millions of Americans spend decades saving for a retirement only to trip over tax bills at the finish line. So it talked about the 3 different kinds of money that we bring into retirement. There's the pre-taxed stuff. That's your 401ks and your IRAs. You've never paid taxes on that money. Then there's the after-tax or tax-free money. If you have a Roth, you've already paid taxes on that. That's tax-free in retirement. And then the taxable accounts. So pre-taxed, after-taxed, and taxable. We got all that going on at the same time.
Yes.
So I'm thinking like a pie here, Charisse. Should my pie be 1/3, 1/3, 1/3, or how do we mix this up? Does there come to a point when I've been plowing money into a 401k and you look at me and you say, no more? We got to have a different kind of money. How do you deal with this?
So we teach this in our workshops. It's a very heavy tax conversation. And there's 3 buckets. Think of it as the pink bucket. That pink bucket is your 401k, your IRA, all the tax deferred dollars you never paid taxes on that you saved with the employer, right? So that's the pink bucket. And then we have a yellow bucket. That's your brokerage account bucket. That is, let's say you buy some stocks because you just sold a house and you're like, Charisse, I have $100,000 and I want to buy some stuff. So you put it in this yellow bucket, the brokerage account bucket. That's the taxable bucket. So that's different than the pink bucket, which is the tax deferred because that was your 401k and IRA. The yellow bucket is your brokerage account bucket. And we have to be careful what we buy in there, right? Because there could be dividend stocks and you have to pay taxes on it every year, and or you can just do growth stocks where you don't pay taxes till you sell. So the question is, should we have more in the pink bucket or the yellow bucket? And then there's the third bucket you're talking about. That's the tax-free bucket. I call that my black bucket. It is my favorite bucket. And by the way, my favorite color is black, but I wear lots of bright colors these days. So remember that. Favorite colors are black, and the black bucket's my favorite because those are tax-free dollars. My goal is to move you from the pink bucket, that tax-deferred 401k IRA, over to the black bucket, my favorite bucket, because all those dollars, as long as you've had it for 5 years and you're 59 and a half and older, it's all tax free. And so why is that so important? Because over time, over the next 30 years in retirement, you are forced by law to pull a higher percentage out of those IRAs every year, that pink bucket, which is going to cost you a whole lot more in taxes over 30 years in retirement. What if you were to roll that pink bucket money over to the black bucket money over the next 10 years and you only pay taxes for 10 years and you live 30 years. And then later on, taxes go up. You're like, wow, that was the best strategy in the whole world, right? But to move money from the pink bucket to that black bucket, so that tax deferred bucket to the tax free bucket, you got to pay taxes that year. And I'm going to show you how to do that. But let me go back to my yellow bucket. That's the in-between bucket. Because your question, Randy, was how much should you have in each bucket? Well, when most people retire, if you have $1 million, you have approximately $800,000 in the pink bucket. And you have approximately, I would say, an average of 100,000 in the yellow bucket, the brokerage account bucket. And then you typically have, maybe if you're lucky, 100,000 in the black bucket, the Roth bucket, because the 401k is where you shove all your money your entire life. So what we want to do is, if I had a choice, I would move 100% from your pink bucket to your black bucket, and we'd have no more pink bucket.
Gotcha.
That's your tax deferred 401ks, and move it to the Roth IRA. But a lot of times, some people just need, there's other things they need. So once in a while, we'll move it from the pink bucket to the yellow bucket, right? That's the taxable bucket. It depends on quite a few things. So we always want to have a little bit of that yellow bucket, because we can do tax loss harvesting on that bucket to give you income in the short run, as long as the timing works out without having to pay taxes. So tax loss harvesting, most advisors don't do it. Your CPAs will charge you a fee to do it, won't do it for free. So again, it's a little confusing, but just remember, pink bucket, yellow bucket, black bucket. Charisse wants your money in the black bucket. And not everybody should do that, by the way, because when we do the math, sometimes the math says otherwise. So let us do the math. And at least you know moving forward. And you can move money from that pink bucket to the black bucket anytime you want, by the way.
Yeah, we've said this a couple of times today, that your retirement plan will be different than anybody else. If someone comes in and they've got a nice pension and Social Security, their income needs might not be that much, but their tax needs might be something big. And then you might be completely the opposite. You've got all sorts of 401k money, but no pension and Social Security. Now you have an income problem, and we have to move things over to that black bucket that Charisse is talking about. Everybody's going to be different. Let's figure out what you need in retirement. Is it income? Is it tax planning? Is it all of the above, and all the different things that we talk about here on the show? Give Charisse a call. Let's figure out what the needs are, and let's start moving the plan forward. Start doing the math on your retirement. 833-368-3680, 833-368-3680, or use the website, pretty easy, ZinniaWealth.com, ZINNIA Wealth.com. And hit the gold box. You'll be on your way. All right, big question. How much do I need every month in retirement? Well, we're going to tell you. The new numbers are out. This is from the Bureau of Labor Statistics. Last year, the average retiree spent $5,000 a month, $60,000 a year. That doesn't seem like a big, heavy lift. You put your Social Security in there, and that seems like it can be done. Now, where did they spend their money? This is interesting to me. 36% on housing, 15% on transportation, keeping the cars going, 13% on healthcare, still no fun here, 13% on food, 7% on utilities, 3% on clothes, still no fun here, and then 3% on household operations. Oh, here it is. 5% on entertainment. That's $3,000 a year. That's ridiculous. Come on, people. All right. So that's got to be something. People come in. Do they know how much they spend per month on stuff to keep the house going? And do they know what that number will be in retirement? And do they think that the fund number is going to be a whole lot more than 5%, and then it gets to be a surprise or even a problem?
I will say 70% of the people who come in and see us, they know what they're spending on their bills, their insurance, if there's a mortgage, car payment, food, electric, cell phone. So they know that part. I think the part that is always hard to tether money and thoughts to is the miscellaneous bucket. And then that entertainment bucket, which is also the travel bucket. So $3,000 a year, when you said the average person is living on $5,000 a year in retirement.
A month.
I was like, that's not my typical client.
You think that's,
right? Our
that's
clients,
higher?
That's low. No, that's low.
Okay.
Our clients live on a much higher number. And that's because, I mean, a lot of them have their debts paid down. But the average monthly cost for their expenses could be between $3,000 to $4,000. So if it's $3,000, it's $36,000 a year. If it's $4,000, that's $48,000 a year. And then again, you need a $57,000 income to pay $4,000 in bills.
Right.
Right? That's
right.
the gross amount because you got to pay the taxes afterwards.
Mm-hmm.
So then if you want to sprinkle in entertainment and you want to sprinkle in travel, you need at least another 10 to 20,000 to 30,000. So we coach our clients like, hey, let's see if we can hit that extra $30,000 just for travel. And we'll build in miscellaneous bucket, birthday present, Christmas present. That's part of your fixed asset, right? So we try to coach people to do that. And then we create this other bucket for the entertainment bucket. And some people are like, Charisse, we're never going to travel. Our entertainment's movies and we like to do stuff in the yard. Then your entertainment bucket will probably be $10,000 a year, maybe.
Mm-hmm.
We had some people's like, Charisse, I'm going to do one cruise and we're going to go, do one other trip. So you probably don't need more than 15,000. But then we convince people, by the way, we're really good at coaching people up to go to Europe and do the Alaska 2-week trip, go rent a house and the Keys for 2 weeks and have all the kids come down, helping them spend their money on them and memories, right?
Mm-hmm.
And so we like to buffer the first 10 years with an extra $30,000 just on entertainment if we can. But how in the world can we do that if we don't build out a design plan, not a cookie cutter plan to give you confidence and be okay doing it? And every year we tweak it and we make changes. Remember, we are retiring by design. Not by accident, not by hope, not by just call me when you need your income. We want to design the next 10 years of your life when you're retiring. Or if you come to Zinnia, because some people have already retired, you get 10 years with us to overfund your retirement in case you didn't get to do it before. So we're going to show you, can you do it? How do we do it? This is how it's going to work. Then we create the next 10-year plan and then the next 10-year plan. So we have 30 years with us. I don't care how old you are. If you're coming in at 70, we're going to assume you're living to 100, right? Just what if you do? You don't know. We do want to look at health and, what's happened in the past, of course, but we want you to have a design. And we do that with our Zinnia 5 strategy. That's our framework. And the philosophy is just retire by design, because these people in this example are not retiring by design. They're retiring by default, and they don't even know what's going on because I can see the math and none of it makes sense. So come in and do the math, because if you do the math, you'll know for sure where you stand.
You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. And in the words of Larry the Cable Guy, let's get her done. Come on in and let's do some math on your retirement. Give her a call, 833-368-3680. If you've been wondering about this, there's no reason to sit around and wonder. Let's get you some answers on what's going on. And if there's any gaps in your retirement plan, let's get them filled. Let's have an answer. As Charisse says, let's have a strategy for it. 833-368-3680. Well, Charisse, I know that there's a lot of people that love the stock market, but there's also a lot of people that hate the stock market. They don't like the risk that comes along with it. I love the fact that my money can go up, but boy, do I hate the fact that my money can go down. So there seems to be a nice little place in between for some people. The people at 24/7 Wall Street said, if you want to be in the market, but you hate the risk, but you want some growth, they suggest using a utility ETF. They say there's less volatility and pretty good returns. Have you found that?
That is, I'm calling BS.
Calling BS on this one. Okay.
BS on this one.
Okay.
And the reason why is I used to trade all of our accounts here at Zinnia. And I was really great at sector rotation. It was my favorite strategy. It's actually I love that strategy. And I've been taught, hey, the utility ETF, it is a safe way to go when markets are going down. Yet the utility ETF dropped 32% and stayed there for a year. It paid what, 3% dividend? Who cares? What is 3% to a 30% loss?
Yeah.
That's a Duke Electric. That's a Southern company. Those are your electric companies. And yes, I know there's times to get into utilities and a time not to get into utilities. But if you have a Fisher investment, they're not getting you in and out of utilities. They're keeping you there. So when it takes a dump of 30, Well, you feeling the pain. That's not a safe money strategy. I had to learn that. Right. And I realized, okay, just because ChatGPT, which wasn't here back then when I was doing that, but if you look at it now, says it's a safe place to put your money. Yeah. Why don't you look at the charts? Look at Duke Electric, look at Southern Company, look at Next Era. They stayed in the dumps for years. And it's like, where's my growth? So listen, we want safety and we want to build it in. But that is the most cookie cutter design that you can get at a big bank and brokerage firm. I can promise you that we will not be employing here at Zinnia Wealth Management. But we do active management. And sometimes you'll see that utility ETF in our portfolio because the timing is right. And then we'll have to pull it out because the timing's not right. Or we'll have less of it because it's starting to get volatile. So that's active management. So that's different than the buy and hold. So again, build in safe money strategies, growth strategies. And it's not just that basic strategy that you are all used to.
But the main thing here, though, is, Charisse, there's different levels of risk in the stock market itself.
Yes.
I mean, it's not like as a retiree, you say, okay, I want to be in the stock market. And you look at them and say, okay, Bitcoin, hedge funds, and private equity. That's not necessarily what we're looking for here. That would be as you refer to, the jiggliest thing out there. We don't want that in retirement, right? We don't want the wobble back and forth and running back and forth in the wind like that.
It's the jiggle. It's the jiggle.
The jiggle effect. Yes, exactly. Yeah. So there are places, though, to go within the stock market that you can find that don't have the jiggle that we're talking about here that might be a little more appealing to a retiree.
Absolutely. And it might have jiggle, just not as much jiggle.
I love the way you talk. It makes sense to me. All right.
Okay. Yeah.
Well, what we want to do is find for you the retirement plan that not only works for you, but is also comfortable for you. Because if you're on your cruise and you're worried about your investments whipping back and forth, what kind of retirement is that? Come on. Let's sit down and find that place that is comfortable for you. We've said it so many times today on the show. It's not cookie cutter. It's not going to be what your brother and sister did, what your mom and dad did, what your coworkers are doing. It's going to be what you are doing. And let's figure that out together. It's a no cost, no obligation meeting with Charisse. 833-368-3680. Give them a call and let's start the conversation. Just start talking through what your concerns are. 833-368-3680. Or if you prefer to use the website, it's real easy. ZinniaWealth.com, ZINNIA Wealth.com. And there's a gold box. And you'll see it. You just click on it. It says complimentary retirement consultation. It's a big word for let's have a meeting. No cost, no obligation. Let's just talk through your retirement. Again, ZinniaWealth.com. We're gonna take a cue from David Letterman today. He made his living doing lists. We're gonna do lots of lists in the first half of the show today. Okay. So on Sunday morning, there's lots of news programs on. There's lots of financial programs on. Barron's is one that's on, and you may have seen it. They had a financial advisor in there. They were talking specifically in this segment about the fear of running out of money. That's a big one for everybody, right? So this particular advisor, she said, there are three things that I think are the biggest threats to people's retirement. Number one, unanticipated health events. Number two, unanticipated market events. And client splurges that break the budget. Okay. So let's talk a little bit. The first two I know we talk about all the time. So let's leave that aside. Have you had clients that have come in and they just like, Charisse, we need to tell you that we bought a $750,000 RV. We didn't tell you and now we're here. So fix it.
Not that big of an event.
Okay.
I've had clients go buy a $250,000 RV or at least put money down if they're doing something that massive.
All right.
But clients always have events that happen. I will say I did have one in the last 20 years, one client that was really for a good 4 years, just overspending based on our plan and the outlay we put together for him. I kept saying, hey, if you guys keep doing that, I am going to worry what happens here in the next 5 to 7 years. And then when that money started to just really run out, there was another bucket of money for their second phase of life that they had to start digging into. And then they wanted to move up north and buy a house and then cash out over half of that. And I just said, if we do this, you're really going to have a hard time. to say the least, we had to let go of the client because I can't work with somebody who's going to overspend and oversplurge. There's going to be moments that we're going to do it, and that's fine for most people. But when you are over splurging on those moments, you have to dial in and do the math. Does it hurt your retirement for the future if you plan to live 20 or 30 more years? Or if the plan was to leave a legacy and now you're just like, okay, we don't want to leave a legacy. We really want to spend our last dollar on our last breath. Well, maybe this is how we do it, right? So I think you just have to plan for it. You got to get it on paper, and you just have to understand what you're walking into. So the expectations obviously are going to change. But that's like an anomaly case for us. But, a splurge is, hey, I need 50 to 100 grand because I'm putting a down payment on a property. Like that wasn't planned out. But usually we give a thumbs up for something like that. But we do test the math and make sure we stress test it against their wishes for the next 30 years just to make sure that it doesn't affect them.
Well, this brings up one of those things we talk about, your bucket of retirement money. There's a hole in your bucket. There's a couple of holes in your bucket. One is a tax hole. Another one is a hole for fees. Another one is a hole for healthcare. And then there's a hole for you, too. And you're spending money, too, out of that bucket, too. How big is that hole? Do we have to plug that hole? No, probably not. That's really not the thing. But this gets me into an area that just kind of chaps me a little bit here, Charisse, when it comes to retirement talk. And that is, I know you like Susie Orman and everything like that, but I'm so tired of a woman who's probably worth $50 million shaking her finger at me saying, I can't have a Starbucks or I can't go out to dinner because that's the biggest hurt of my retirement. This whole thing where they start everything with don't do this, don't do that. You got to do this. You got to do that. Yeah. I was in the car with my wife the other day and we got into a retirement show and she looked at me and she goes, you know what? I've spent 40 years of people telling me what to do. I don't want people telling me what to do in retirement. I want to be the boss. I want to be the person who spends my money and this is my destiny and this is what I want to do. And I thought that was pretty profound because that's the image that she's getting, and what she's getting from the financial industry is don't. And I don't think that's what she wants to hear.
No, I think clients are used to hearing, or people who've never come into our office are used to hearing, well, you can't spend because you might run out of money. You can't spend because you probably need it for long-term care. What they're not used to hearing is, hey, we can actually spend $20,000 to $40,000 more a year for the next 10 years and then still have long-term care protected and still potentially leave a legacy, depending on the math, of course. And so I think we've just always heard for years. Think about the baby boomers. Their entire lives, they heard from Dave Ramsey, save, 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 which is great. We want to save. We need those leaders in our life. And then Susie Orman, no. Susie Orman really came in at a great time because people were really good listeners. Could you imagine Susie Orman saying right now, you're denied, or no, you can't go on your trip, or no, you can't have your coffee? They'd be like, screw you, Susie, right? Because
new advisor.
Well, and the time has changed. So you can't talk about what you talked about 20 years ago today because the kids are different and how they save is different. And we are having less people save on top of that, which is a dilemma. So I do think that over time, you have to adjust. When you finally deserve, if you are a good listener and a good steward to what Dave Ramsey said and Susie Orman and Clark Howard, there's a time to spend. You can't say no forever. And we implore people to do the work with an advisory team that will coach you up and say, hey, this is how much you can spend and here is why, based on the different elements we're plugging into your portfolio. Like that is, to me, like Christmas all day long. If I was retired and I walked into the office and they said, hey, this is what you could do, let's stress test it. Okay, if we could do a little bit more, this hurts us in this department, but if we did less, we gain here in this department, whether it's legacy department, the long-term department, or paying Uncle Sam now, so there's tax-free later. There's different departments in financial planning, and having an advisor that actually understands the compartments in these departments is really, really important to help guide you to make those better decisions. Because you could very well come in and I'll be like, hey, you need all the money you can get. We can't even afford to roll IRAs over to a Roth, or you have health issues right now and there's a lot of money being poured out. So that means we might have to take away from here, right? And people are always willing to transition because whatever is happening in their lives, that's usually what they push towards. But just having a shoulder to cry on, a shoulder to talk to, and get realigned, because you're always in retirement, you're always unaligned, then you get aligned. And so you're always realigning. So there has to be a plan that makes sense with it, right? That you can always track.
I think every week on this show, I use these three words: confidence to spend. You want to go into your retirement and realize I can do these things and it's not going to hurt me. I'm not going to run out of money. And because I have an income plan, I have a strategy for my retirement, and it's built for not just 5 years or 10 years. It's built for 15, 20, 30 years. That's what we want to do for you at Zinnia Wealth. Give Charisse and the team a call. Let's sit down and do your retirement math. If you've never sat down before and say, what's coming in, what's going out, this is what I've saved, this is what I want to do, let's put the whole thing together. That's what it is to do your retirement math. We'll do it for you at no cost or obligation. Go to the website. You can start there, zinniawealth.com, ZINNIA wealth.com. And there's a button there. It says complimentary retirement consultation. Click on that. You'll be on your way, or just bypass all that. Give them a call. 833-368-3680. All right. Here's our second list in our first half hour here. All right. If you hire a financial advisor, you probably think, well, I'm going to hire this person and they're going to show me exotic investments that nobody else knows about, and it's going to make me a rich person. Okay, yeah, I get that. All right. But there are a lot of people that think that you don't have to do that. Boring is better. The people at Vanguard, they follow Jack Bogle. They call themselves Bogleheads, and they came out with an article that says all you need is these three things. Three things only: a U.S. stock market index fund, an international stock market index fund, and a U.S. bond indexed fund. That's not very exotic, and that's kind of boring, actually. But do you think somebody could run their retirement with just three funds like that? How many do you have to have?
Well, I think you need more than three funds.
Okay.
I truly believe that.
All right.
Because if you have the U.S. stock market fund, that might be more like the S&P 500, right?
Follows the index, right? Yeah.
Follows the index, right? And everything goes up. Well, that's great. If you have a half your money in there and the market goes up 30%, then yeah, you're probably going to get your 30%. But then if the stock market goes down 30%, you're also going to lose 30%. So is it better to make the 30% and also potentially lose the 30%, possibly 40%? Or is it better to make maybe 15% and mitigate the downside risk to 5% or 7%? And it's all perspective, Randy. It just depends on the age and season of life you're in, what you've experienced, what you want your money to do, and what you don't want to see your money do, right? And so, for example, we have some clients that come in and say, Charisse, I don't want to lose a dime. Well, you're not going in that portfolio. We have some people, and I just sat with one of them, who says, I can handle all that risk. Give me more, right? And so everybody's going to be a little bit different, and we have to be able to cater to both. So even in that S&P 500 fund, you can invest in three strategies, for example, in the S&P 500 fund. One that takes no losses, one that takes 100% losses, and one that takes half the losses, which is really incredible. Most people are like, what is she talking about? Well, that is exactly what we do in our office, to split up the diversity inside that risk bucket at the same time, depending on the season of life you're in. And most clients want all three of those buckets. Same thing with the international fund and the bond fund. Like, I don't believe in just a bond fund. When you say, hey, I'm going to get this bond fund, for example, let's call it the aggregate bond fund at Vanguard, all corporate bonds, and interest rates start shifting gears, well, guess what? Vanguard ain't moving those bonds fast enough to protect you, so those bonds are losing money, right? What if you had an active bond fund that has bond funds among bond funds inside of them, so they're not overlapping and doing the same thing? And they can manage the interest rate environment, because when interest rates go up, bond values go down, and vice versa. It's a teeter-totter. When interest rates go down, bond values go up. So there should be a triggering mechanism inside your portfolio that says, Oh, I have this aggregate bond fund, maybe all corporate bonds. Hey, interest rates are going up. Uh-oh, my bond's about to go down. And so most humans aren't going to make a change, but an algorithm will if you have it built in, and or you have a human element that does active trading inside of a portfolio. So we just want to be not creative. We're not reinventing the wheel, but we want, you know what people want, Randy? They just want to know somebody's thinking through this stuff as this stuff is changing, because they want to be in Tahiti drinking their Mai Tais. They want to go to cruise ships with their spouses. They want to go camping with their grandkids. They don't want to worry about this. This is my job. This is my time to shine and impress the people that are trusting us most. And it's their time to not give a care and make sure they don't run out of money and all their accounts just lose 50%. And now they're just like, okay, well, we got to cancel that trip and this trip and that trip, right? And that's what people want. So I don't like getting all complex on radio about the different portfolios. But no, you shouldn't just have a U.S. fund. You shouldn't just have an international fund. And no, you shouldn't just have a bond fund. I call this the dumb fund. That's the dumb plan. And so I know some people are like, oh, that's a little rude. Yes, it is rude because I've seen it just not work. I've also seen it work. But does it work when you start living on your retirement dollars? And the answer is, if the market's going down, no. If interest rates are going up, no. If anything could be happening, right? And there's a lot of noise out there today. So, we're not trying to seek a 50% return, right? I just had a review with a client. We made 47% one of his accounts. His other account did 25. The other account did 15. The other one did 8. And I said, are you so okay with this strategy? He went, absolutely. Because when the market crashes, he's like, that 8% account ain't going to go down 50%. He's like, I have peace of mind knowing that, Charisse. And so it's bobbing and weaving. And not all of our money has to be making those double-digit returns, because it's not what you make, it's what you keep.
I love what you said there about the 3 things you should be worried about are maybe Hawaii, Alaska, and Cancun, not index funds and bond funds and international funds. Let's get our priorities straight. That is why you would bring all of this to Charisse and let her worry about that part. You worry about having fun and having a great time in your retirement. Give Charisse a call. Let's sit down and do the math on your retirement. It's a no-cost, no-obligation look at what you've done, what you want to do, put it all together. Are there any gaps? Do we have to fill any of those gaps? Are you worried about Social Security cutting back? Are you worried about health care? Let's get all those worries out on the table. Here's the number, 833-368-3680, 833-368-3680, or ZinniaWealth.com, ZINNIA Wealth.com. Hit that gold box that says complimentary retirement consultation. All right, the rule of thirds. This is a new one on me, Charisse. This is how we should parcel up our money. 1/3 in guaranteed income. That's your Social Security, pensions, and annuities, things like that. 1/3 in fixed income investments. That would be bonds, CDs, and treasuries. And 1/3 in equities. That's stock market, ETFs, and mutual funds. So just parceling things up. Is there a percentage that you would have in each of these buckets, or is this crazy, Charisse? Is this just another clickbait? Is this good stuff? What are we saying here?
Is it clickbait? I mean, yeah, it's actually really good clickbait.
Because I clicked on it, yeah.
You clicked on it. So you can follow the rule of a third, a third, a third. I think you can get yourself in a little trouble there. What I do like about the third rule is the first rule in the 1/3 rule. And the first rule is you have your Social Security with your pensions. If you don't have pensions, what you do, you sprinkle into an income annuity that's guaranteed for life, so that the 30-year money that you have coming in pays your bills, always and forever, even if somebody passes away. So making sure that your fixed expenses are totally covered. I like that third. But some people need more than a third of their assets to cover the fix. So now you're really looking at a 50-50, because if you got a smaller Social Security, no pension, then you got to put more money into this annuity to cover that fixed bill environment for the rest of your life. Then you only have 50 left over. So I want to squash the strategy, but I want you to understand the thinking is valid. I don't like having a third of our money. This says a third of our money in fixed instruments like treasuries, bonds, and CDs, because people take that to the next level. And all of a sudden, if you got $1 million, you're like, I'm going to go put 300,000 in CDs. No, we don't want to do that. Or I'm going to put 300,000 in money markets. No, we don't do that. Or 300,000 in treasuries. No, we don't want to do that. But we do want to think through it and maybe sprinkle a few dollars in each one of those investments and really decide how that bond portfolio's outlay is going to look, and then sprinkle in some other strategies. I call them safe money strategies that could be even more icing on the cake. Let's put it that way to your investment portfolio. The other third is the stocks, mutual funds, and equities. Well, number one, we do not like mutual funds, and you shouldn't either. But until you sit with me in my office, you won't know why. But we do like stocks and dividend stocks, and we do like exchange traded funds. But I think the first question we got to ask is, do you really put a third of your money into the stock market? And you're 65 years old, or between 65 and 75 years old, that's the part you really got to think through. Like, do you really want to risk a third of your money? Mm-hmm. How much of that third do you need? And is it really half of your money you're risking, right? So that's a question you have to ask yourself. So remember, we used to talk about the 40, 30, 20, 10 strategy. Mm-hmm. To me, that would be, we should call it the 1/4 strategy, right? Maybe 40% of your money definitely buttoned up safe, 20% at risk, 30% somewhere in the middle, and the other 10% is part of your income and liquidity phase that you need for the next couple of years. So it needs to be more strategic than that. But if you're going alone and you understand what this means, then yeah, it's not a bad rule to follow. But if you're trying to dial in, leave more of a legacy, make sure there's a long-term care plan built in, make sure that, there's assets there for when you pass away for the surviving spouse. You probably need to delve in just a little bit more, build that income plan to make sure that does make sense, because I have not met too many of my clients where actually that would make sense. I would say a few probably certainly will. But I think what the moral of the story is, the guaranteed income is like, it's absolute certainty. It's going to be there. The other third is the fixed income, the safer stuff. Hey, this is our money that we're going to be living on most likely for the next 5 to 7 years. And then the third portion of our money is like, okay, how much can we lose and emotionally handle to lose over the next 10 years if we don't need to touch it? So I'm okay with a third of your money in the stock market if you promise that when it goes down and crashes and burns, could be next year, it could be 3 years, it could be 10 years from now, wherever it is, that your mitts off, you're not going to sell it at the bottom. Therefore, you're also not going to need it when it hits the bottom because you have your other buckets full. So you really got to think through it. So.
Well, we talk about the 3 aspects of retirement planning, and every retirement plan has to have preservation, income, and growth. Now that spells pig, so it's not a great marketing campaign, but
does it? Oh, I like it. How can we turn that
the pig problem? Yeah, but actually these 3 kind of go along with that. The guaranteed income is your preservation, your income, and then the third in equities is your growth. Mm-hmm. So there is some truth here, and there you can start maybe use that, as we say many times, as a guideline, as a starting point, and say how much of my income do I need here to make up what I need? And that's a conversation for you and Charisse. And when we talk about doing the math on your retirement, this is exactly what we're talking about right here. How much do you need per month for essentials? How much do you need for fun? Let's figure that out. And that is what it is to sit down with Charisse. Give us a call. Give the team a call. Let's get a date on the calendar and go through it. What have you done? What have you saved? Where is it? How's it doing? And what do you want to do? Let's put this all together, kind of put it into the salad bowl and see what comes out. And many times there is something there that you hadn't thought of. Might be a tax problem. Might be a healthcare thing. Maybe you don't have anything in the wills and the trusts and the legal documents. That's a part of this too. Let's get it all taken care of. 833-368-3680. 833-368-3680 or online, zinniawealth.com, ZINNIA wealth.com. There's a gold box. It says complimentary retirement consultation. Click on that. You'll be on your way. Charisse, that is all the time that we have on this one. I'll give you the last word.
If you want to spend more in retirement, pay less potentially in taxes, and be more diversified, you're going to want to hear this show. So as usual, live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.